Well, I have been promising you that we would talk about long term care. So today is the day. And I have invited a guest speaker, Jay Robinson, who is an independent insurance consultant with InSource, to help me provide you information on long term care. So I talk to Jay anytime I have a client with specific long term care needs because he has that direct relationship with the insurance carriers and know the pre-qualifications that are needed for each long-term care product. So on that note, I'm going to introduce Jay Robinson of InSource and let him take the presentation from here. Good morning, Jay.
Good morning. Thank you, Darlene. Hey, I'm happy to be here. Thank you for inviting me and the opportunity. As Darlene mentioned, I am a consultant working behind the scenes with Darlene and financial advisors all over the country. My firm has relationships with 20 to 30 different insurance carriers and multiple products with each carrier. So we can help line up the right type of product for the right type of need. But what I've found in my 20 years of experience is, especially as it relates to long-term care, many people don't understand all the options that are available to them, what different types of products and what different types of features. So what I'd like to do today is spend some time walking through the 4 options that you have available to prepare for long-term care. So you've probably seen this analogy before, but what is the goal with mountain climbing? And most people say that the goal is to get to the top. But the real goal is not just the climb, it's also the descent. And I saw a number, I like being outdoors, I study it a lot, but I saw a number that said in regards to all the people that have climbed Mount Everest and ultimately those that have died Mount Everest, climbing Mount Everest, 56% of all deaths are actually on the way back down.
Wow.
So we put all of our planning into the climb up, but we don't plan adequately to make the descent back down. Retirement and retirement planning is much the same. We put so much focus on getting to that retirement age. We put so much focus on saving and planning so that we can retire at the right point. But we need to put a lot of focus on the descent in retirement and what could go wrong in retirement so that we can plan appropriately today to make sure that that descent goes as we hope. So what are the 4 issues that could potentially affect the descent down, the retirement? The first, having enough income. And these are annual studies that you can find on the internet of retirees, that what are the 4 issues that we're concerned with in retirement. The first one is always having enough income. The second, low interest rate environment. If I have a portfolio, will the interest rate environment allow me to still draw the income and savings that I need? The third and fourth one kind of go together: medical expenses and extended health care costs. We're going to focus today on that extended health care cost component of the 4 issues. So what exactly is extended health care? It is simply another retirement expense that can cause income needs to increase. We plan ahead to have X amount of income per year in retirement, and that's going to meet our needs. Extended health care is simply another expense that will cause that income need to increase each year. It's also referred to as custodial care. But keep in mind, extended health care, long-term care is not necessarily nursing home care. And we're going to get into that in 1 second. Extended health care is simply requiring assistance to do 2 of the 6 activities of daily living or severe cognitive impairment. And we will get into those 2 of the 6 activities of daily living shortly. And the fourth item, most individuals, when they think of long-term care, they do think of that nursing home, as we just looked at in point 2. But most people prefer to be in their home receiving care, and planning ahead and putting a long-term care insurance policy in place can help generate that income stream to allow you to receive the care that you need in your home. So as I mentioned, long-term care is more than just a nursing home care. Long-term care is intended to provide support to those that as soon as you need as soon as you meet the requirement for 2 of 6 activities of daily living. This just means that your physician says of these 6 ADLs, you do need assistance with at least 2 of them. And you can see what the list is here. Long-term care solutions can help pay for any level of care. Again, it's not just nursing home. It can help pay for home health care. It can help pay for caregiving, care coordination. It can help pay for adult daycare. It can pay for assisted living, and ultimately nursing home and hospice care. There are a lot of statistics here. You can do your own research. Go to Google, type in long-term care statistics. Some of you have probably already done this. These are statistics that have jumped out to me when I do it. I'm going to talk about statistics in a second because while it's important to know some of these, I think it's important to also know that we shouldn't just focus on these. So some of the statistics that you might see out there, and these are done each year and made public, is that 7 out of 10 people age 65 or older will need some form of extended long-term care assistance in their lifetime. 7 out of 10. The question I get often, well, if we do need to go to a nursing home, how long is the average stay? And for women, it's 3.7 years. For men, it's 2.2 years. I'm going to highlight the next one, the number of people providing unpaid care in 2015. So the stats a little bit old. 41 million people provided unpaid care for family members in 2015. We'll get to that in a second. The concern that we've seen increase over the years is dementia, Alzheimer's, and what can that do to care? The average length of LTC event for someone with an Alzheimer's diagnosis, 8 years. So if we plan for just the 2 or 3 years and we come down with a cognitive impairment, we may need care for double what we've planned for. And we're going to look at that in a second. And I've also included median costs at the bottom of the page. Now, these are nationwide costs. What I want to highlight here, averages are great, but averages aren't everything. An average just means that 50% of people are lower than that and 50% of people are higher than that. So it might be good to plan for an average, but we need to also plan what if I need more than average. And I want to take a second to take a look at some of those more than average statistics. So the question, we saw the stats on the last page of what the average statistics are in the United States. And that takes everything from New York to Alaska and everything in between. But what I like to focus on, there are many calculators out there that can drive down exactly to where you live. The one I'm sharing on this screen that Darlene is putting at the bottom as well, this is with One America. One America is one of the largest long-term care insurance writers in the industry. But this is something, they're not the only one. And what I'd like to focus on now, since many of you are housed in Colorado, is let's look at the current costs for the different various types of care in Colorado. The neat thing about these calculators, you may be in Colorado now, but you may want to retire here in Indiana, where I am, and you can go in and see what the different costs of care. And I think it's important as you plan your retirement, as you know where you want to be, to factor in that cost of care where you're going to end up being. So in Colorado specifically, the average cost of care last year, these numbers are current for all types of care, are $76,140. You can click on and see what the types of informal care, which was about $70,000 last year. Home care, about $5,500 a month. Assisted living and the nursing home. We talk about 2 or 3 years as the average. The price of nursing home in Colorado last year was just over $110,000. What I like about these different calculators is that is a state average. You can drive down specifically to your location, as many of these calculators have different locations within every state. Here in Indiana, we have Indianapolis and southern and lower parts. But the other neat thing is, we may be 10 years from retirement. We may be 20 years away before a potential long-term care claim, a potential long-term care expense. So these costs today are good to know, but we really need to, as we do our retirement planning and plan and prepare for long-term care, we need to have an idea of what these costs will be in the future. These calculators, you can forecast ahead, and this is using the average cost of increases that we've seen over the last few years, as well as inflation, to show you what the projected costs will be in the future. So for example, maybe we're 55 and planning today, and we want to be prepared for a care event that might be 20 years down the road. Year 2021 is not as important as what is the projected cost in year 2041. And as you can see, nursing home, based on the current trend over the last decade, the cost of 1 year in a nursing home in 20 years could be upwards of $250,000 for 1 year. This is why it's important not just to look at the stats today, but forecast ahead, project ahead for what those might be when we need them. So the other thing we need to keep in mind is not just what are the average costs of care per year, but we've seen what the average stay in a nursing home and what people commonly think of as how many years will I need long-term care. What you see here, this is an interview of 7 of the largest long-term care insurance carriers in the industry done back in 2019. And the question was, for both men and women, what is your current, longest, as well as most expensive claim for male and female? And you can see what the lists are here. So for someone, let's look at number 1. The longest claim right now for a male is just over 14 years, and the total cost is $2.2 million. We had only planned for, go back to the statistics, 2.7 years of care, because that's what men on average need. We would have severely been underprepared for what long-term care actually did for us in our portfolio. So I think it's important to keep those average statistics in mind, but this is a good representation of statistics aren't everything. We need to plan for these scenarios that could have happened like this. So what are the 4 ways to prepare for long-term care? Well, 1, we can self-insure the risk. And we're going to get into each of these in more detail individually. But the 4 ways to prepare for long-term care in retirement is self-insure the risk, traditional long-term care, asset-based long-term care, and life insurance with a long-term care rider. So self-insure the risk. What exactly does that mean? Well, this is the default planning. If you don't have a plan in place, the default plan is there for you. This means that you are going to cover dollar for dollar any expenses that you have as it relates to long-term care needs. Everything is going to be paid out of your portfolio and or your income. That's not to say it's good. That's not to say it's bad. But what I'd like to do is look at the pros and cons of each of the 4 options. And the pros with self-insuring the risk, well, if we don't have insurance, if we're going to cover the costs, that means we're not paying a carrier any premiums. And that also means that if we are one of the 30% that don't need any form of long-term care, then we have no costs either. And we don't have to qualify medically, and anything that we have in our portfolio and our assets, if we don't need it, stays in the family. But the cons, as we go back and look at that previous slide, where care is needed by some of 10 to 14 to 19 years, we could run the risk of having to pay a lot of money, an unlimited amount of money, out of pocket, out of our assets, out of our income, if we ever need long-term care and extended care. We could spend down our savings. Think about that last example. If we had saved up $2 million because that was going to be enough to make our descent down, and we were gentleman number 1 who has now gone through $2.2 million, that means we've spent everything. And if I have a spouse, that means my spouse has nothing at that point because we've spent it all on my care needs. We may have to liquidate assets. We may have to sell things that we ideally would not sell. Here in Indiana, that could be farmland. We would have to liquidate assets to cover the costs that are needed for extended care. And go back to those slides a couple slides ago. Remember how I said 41 million unpaid caregivers? If we self-insure the risk, if we don't have someone to come in to take care of us or to help facilitate care, we're going to have to default to family members. I've seen this firsthand. My mother had to do this for both my grandparents, she and her sisters. Family members will have to come in and take care of us. And the question is, what does that do between family members if one person's carrying the load and the burden while another is not?
I personally have a friend who is currently doing that with her mom. She is the primary caregiver. So I have learned firsthand how important it is to have some kind of assurance with respect to long-term care. But I have a quick question for you, Jay. Mm-hmm. So many people that I talk to believe that Medicare will cover their long-term care costs. So is that true?
Great question. Many people think that Medicare will cover it. And Medicare is not meant for long-term care. Medicare is meant to help cover medical expenses. Medicare will cover a short duration. Usually it's up to 100 days as the focus is on medical care needs. It's not meant to cover custodial care, which is commonly what long-term care or extended care is. So it will not cover, after the 100 days are met, it will not cover care needs going forward.
Okay, thank you.
So self-insure the risk is number one. Number two, traditional long-term care. This is traditional long-term care has been around for decades, and many of you may have looked at this before or read about this, but this is long-term care insurance that pays a set daily or monthly benefit if those 2 of 6 ADLs are met. Remember, we looked at those activities of daily living. Long-term care insurance, whether it's this one or one of the future ones, if you meet 2 of 6 ADLs, it will pay out benefits after that time. It will generate an income stream when expenses are needed, when expenses increase because of extended care. So the policy with a traditional LTC, you will normally see it stated in a set duration. It could be 4 years, 5 years, 6 years. It could have a specified benefit pool. You might have $500,000 of LTC benefits as the amount that you could receive. Traditional long-term care has been out there for quite a while. There are pros and cons with this. Pros, this is like maximum long-term care benefit. It's almost like auto insurance. I'm buying this for one thing only. I am paying a premium monthly, quarterly, annually, and the benefit I have is long-term care coverage. That's the only thing that this does. It is a way to get the most maximum benefit for the premium. Many states have partnership programs. Traditional long-term care can qualify if you meet certain requirements. If you are married or in a relationship and look at traditional long-term care, you can get a discount even if your spouse is not applying for a policy as well. If you and your spouse are looking at a traditional policy together, there are some features like shared care benefits where you may each have, for example, $250,000, but if you spend through your $250,000, then you could tap into your spouse's portion for your care needs. You can add inflation, home health care. We're going to see a trend here. Home health care is added on most of these policies, traditional LTC being one of them. With traditional LTC, premiums may be deductible. And the other thing, unlike self-insuring, with a traditional LTC or the other options we're going to look at in the future, you would have access to a care coordinator. More importantly, your family would have access to a care coordinator. So whenever long-term care, extended health care is needed, your family, someone that loves you, will have someone that they can call to say, what do we need to do first? They don't have to go to the internet and type in, what is the first thing I need to do? They can have a quarterback to help coach them through the stages as care is needed. The cons. You've probably seen this in the news as well. These are annual premiums, obviously, annual premiums compared to self-insuring where we wouldn't pay anything. We would be paying an annual premium to an insurance carrier. Traditional LTC also has the concern of future premium increases. There is no such thing as a premium lock on long-term care. We've seen some carriers over the last few years as life expectancy extends, as medical advances get better. We've seen traditional long-term care insurance carriers actually raise premiums for those reasons. With any form of insurance, you do have to qualify with underwriting. That means you may have to do a doctor visit or have labs done, but you would have to be somewhat healthy to qualify for one of these policies. The biggest knock on traditional LTC, along with the chance that premiums could increase, it is like an auto insurance policy. You know, if I have a car insurance policy and if I never have a wreck, I don't need my auto insurance policy, right? I've had it, and that's great, but I've never had to pay for an expense of a car claim. And the same thing is with traditional LTC. There is no other benefit besides that monthly benefit. So if I never need it, and I've paid premiums for 40 years, and maybe I'm one of the 30% that never need any form of care, there's nothing to show for it. So I've had the coverage, but there's nothing at the end. And lastly, claims process. This just means that the insurance carrier, as we look at any of these options, the insurance carrier is happy to work directly with the facility providing care. Claims process just exists because of that step alone. So I don't know if it really should be listed here compared to self-insuring, where you would be covering everything out of pocket and not having to work with an insurance carrier. Claims process would be listed as a con whenever it comes to any of these forms of long-term care.
So as my YouTube viewers know, they all know I love to ask questions. So Jay, I have a few more questions for you. So is traditional long-term care the only way to get asset protection with a state partnership program?
At this time, yes. And the primary reason of that is because it has just one benefit. And it's that monthly, annual, daily benefit. There's nothing else. As we look at some of the other features where there are more benefits, including life insurance, the death benefit is the reason why they do not offer state protection.
That makes total sense. And then one other question. So is traditional long-term care the most cost-effective way to get long-term care coverage?
As you look at quotes today, the answer would be yes. So as you would look at this policy versus asset-based or a life insurance policy, the annual premium, the monthly premium on this would be lower. And the reason is it provides just that care benefit. But you have to keep in mind that the premiums could increase going forward. Now, carriers today have priced products today that should be more stable because of the interest rate environment, because of life expectancy increasing. But we've seen carriers in the past increase premiums 2 or 3 times. So the question is, even though it might be the lowest cost today, if premiums would happen to increase in the future, what would that look like compared to some of the other options that are available?
Gotcha. Thank you. Thank you for providing answers to my questions, because a lot of times I ask questions and then don't provide answers to my viewers.
Absolutely. So we've seen self-insured, we've seen traditional LTC. The third one that we're going to talk about is asset-based LTC. This has been in the insurance industry the largest growth, the most requested over the last 7 to 8 to 10 years. And we're going to see why in a second. Asset-based long-term care. It is a life insurance or an annuity policy that takes a set amount of money and turns it into a long-term care benefit. It focuses on long-term care benefit. So while it's a life insurance policy or an annuity policy, and that's great, its emphasis is on long-term care. And typically it will provide 2 to 7 years of long-term care benefits. There is an option out there, one carrier right now with inside the asset-based LTC, that you can actually purchase a policy and have an unlimited lifetime benefit, unlimited. So as we go back to the stats a few slides ago, those 7 men and women that had the long 10, 12, 14, 19-year claims, a policy with a lifetime benefit pool would pay that income stream the full duration, whether it's 19 years or not. 2 of the 6 activities of daily living are still required. It is still LTC. And we commonly see these policies funded with single premiums. It can be an annual premium, but it might be using some savings and repositioning it to move it over and leverage up into that 2 or 7 or unlimited benefit duration. But it can be set up on a 10 pay, a 20 pay, or a lifetime pay as well. Pros and cons. Everything about asset-based long-term care is fully guaranteed. So there are no premium increases. If you purchase a policy with a 20 pay, 12 years from now, the premiums will not increase. You purchase a policy with a single pay, 20 years from now, the policy will not be forced to run out. Everything is fully guaranteed to the claims paying ability of the carriers that provide it. These policies, while it's life insurance or annuity focused, they do offer life insurance or annuity benefit, but the focus is long-term care. So compared to a traditional LTC that has just one feature, these policies might offer a decent life insurance death benefit. So if we put money into it and we never need care, our family or someone as a beneficiary will still receive an income tax-free death benefit, for example. The policy has guaranteed cash surrender values. So we might move over, again, a single premium. We might make one-time payment, but we know in the future, because the policy is guaranteed, if we change our mind, if we want access to the money, it does have guaranteed surrender values that we could surrender the policy or take distributions from if needed as a worst case scenario. Typically, you can add inflation. Most of the carriers and the products out there do have a 3% simpler compound or 5%. Inflation is an option with these asset-based LTC policies. Everything's guaranteed. As you look at an illustration, everything is simpler to understand than some of the more complex versions of traditional LTC or life insurance with a long-term care rider. Like traditional LTC, this does cover home health care. So I want to emphasize the point. It is not nursing home care. This is extended care. This is long-term care. And these policies do cover the cost, the expenses of someone coming into your home to take care of you. And like traditional LTC, your family would have access to a care coordinator to help along the way determine the right path of care that's needed. 2 big cons with asset-based LTC. And one, claims process. Again, you just have to work with an insurance carrier. The insurance carrier would work directly with the care provider, but you do have to qualify with underwriting. You do have to provide a history of your medical information. Some carriers might do this on a phone call only. Some carriers might get more detailed and need lab work done, for example. So it is a little bit longer process than if we self-insured and didn't do anything.
All right, so I have another question for you. Go figure. So I have done so many videos on fixed annuities that I want to ask this question, because what I understood about a fixed indexed annuity with a long-term care rider is that you should consider that as supplemental coverage. And then I also want to ask, I'm going to throw this in because I think you can answer both at the same time. I also heard that there's a lot of fixed indexed annuities with a long-term care rider where underwriting is not required. So can you clear those 2 things up for me?
Correct. So with annuity products, whether it's an indexed policy or a fixed policy, and we won't get into that today, you can purchase and use annuity dollars, one of these annuity policies with long-term care. And the neat thing about this is you might get 3 times or 5 times your deposit as a total benefit balance. So even better, even though it's an annuity policy, because of the Pension Protection Act, anything taken out for long-term care is received income tax-free.
Wow.
So anything, even with gains, can be received income tax-free to help cover the long-term care costs. Now, as it relates to the second question, you are absolutely correct, because many of these policies, depending on how you design it, there could be just knockout questions. It could just be answering 10 or 12 questions and being able to get a policy. Some policies, some annuities, if you do turn 100,000 into 500,000, for example, you might have to provide a little bit more insurability, more medical underwriting, just because of that leverage. But you can get some of these policies by answering correctly to a dozen different health questions and being done. It's a pretty quick process with that.
That makes total sense. Thanks for clarifying that.
Absolutely. So the last option, we've covered self-insuring the risk, traditional LTC, asset-based LTC, and the last one is life insurance with a long-term care rider. Now, I know I mentioned that a second ago with asset-based, it is a life policy, it is an annuity, and it has a moderate death benefit. This is a traditional life insurance policy as a long-term care rider. What do I mean by that? This might be a $500,000 life insurance policy with a 2% monthly benefit, which means 500,000 times 2% would give you access to $10,000 per month of long-term care benefits. You are accelerating the death benefit to help cover your extended care costs. 4%, again, another example, if you have a $300,000 policy with a 4% rider, that would be $12,000 per month. It is spending down the death benefit dollar for dollar, income tax-free, to help cover the costs of care while you're alive. It's a way to have a living benefit. Almost make yourself the beneficiary of the policy so that you can benefit from the death benefit to help cover those costs to leave the rest of your portfolio to your family. Pros and cons, this will be the highest death benefit option available. So I mentioned that the life policy a little bit ago, the asset-based LTC is a moderate death benefit. This will give you, this life with a life long-term care rider will give you the highest death benefit. You can have 500,000, you can have $1 million. Some carriers will allow you to have multiple millions of dollars with a 2 to 4% monthly benefit. So this is a way to get, if you need more life insurance, this is a way to cover that need, to cover that life insurance need, but also have the benefits available for you for care costs. 2 to 4% accelerated monthly, as we discussed. This too can be funded from a single pay to a lifetime pay. This could be used using cash values from an existing policy. This could be using R&Ds if you don't need it. So there's a variety of ways that you could structure this from a single pay to an ongoing annual or monthly pay. Much like the other types, this does cover home health care, as you can see a trend here, and you would have access to a care coordinator. Cons, it's insurance. We're using someone else's money. We're someone else is going to help pay for it, and we would have to qualify for underwriting with this. It would not be uncommon to expect that you will need to have a physical exam completed, probably medical records retrieved from your physician. So this might be a little bit longer process to qualify for underwriting because, think about it. If we have $1 million death benefit, some carriers putting a lot on the line on your health, and they want to verify that medically you qualify for that coverage. Again, it's a pro, it's a con. This can be structured with a single pay or a lifetime pay. I'm seeing a lot of people right now structure this on a 10 or 20 pay basis to make sure that the policy is paid up. If I'm 55, I'm going to retire in my early 70s, maybe I want this policy paid up by that time. And you can do that too. So not necessarily a con, but something to be aware of. On the asset-based LTC, the policy had guaranteed surrender values. We knew in the future what our walk away or our cash values might look like. And what you'll see with the life insurance with long-term care rider, the emphasis is on life insurance and a great monthly benefit. But because of that emphasis on life insurance and that tax-free life insurance death benefit, the surrender values are typically going to be lower with the life insurance and long-term care policy. And that's something that Darlene can put side to side if you'd ever like to see a comparison. And last, claims process, which I think we've talked about enough at this point. So, Darlene, any questions about life insurance with a rider?
Well, would you think it was kind of strange if I didn't have a question?
That's why I wondered.
So in general, I'm not looking specifically, in what situations would an asset-based long-term care policy be a better option than a life insurance with long-term care rider, or vice versa?
So it comes down to what your needs are. I see a lot of asset-based LTC, especially now when interest rates are low. Maybe we don't have a large death benefit need. We can reposition low savings accounts and get a long-term care benefit if that's our main focus. Especially now as we have all this uncertainty of taxes in the future, and whether it's estate taxes or capital gains taxes, where our beneficiaries might be forced to pony up taxes on wealth transfer. A life insurance policy with a long-term care rider may be better suited for that person, because if they never need it, if we buy $1 million policy with a 2% rider and we never need it, our beneficiaries will receive $1 million income tax-free that could be used to help pay some of those taxes. So both are great options, but if someone is more death benefit focused, more life insurance focused, the life insurance with long-term care policy typically makes more sense.
That is an excellent explanation. I say that because I like to talk taxes, as my viewers know. So thank you for that answer.
Absolutely. And with that, Darlene, I'll turn it over to you.
Well, thank you so much, Jay, for taking this time. The presentation was very enlightening and informative, and I appreciate you spending this time with me. And if you're interested in obtaining long-term care, no matter which option that we discussed today, be sure to click the link below to apply to become my client. And also, don't forget, if you like this video, give me a thumbs up, subscribe to my channel, and share it with your family and friends. Let's get the conversation started on how you can live your best retirement while not outliving your money.